Maybe my starting yield is not super great, but I know as a dividend growth investor that doesn't matter. What matters is my yield over time. What's it going to be in 10 years, 20 years, 30 years? Is the dividend sustainable? Is it growing? Sometimes in the world of investing, it's all about the mistakes that you avoid. It's not actually what you do, but it's more about avoiding making mistakes. I want to share today 5 mistakes that I have learned from over the years as a dividend growth investor. These are mistakes that I've made at one time or another. I've learned from them, and I want to share them with you today so that as a dividend growth investor, perhaps you can learn from my experience. Mistake number 1, yield trap. We've all seen them out there. These are those stocks that offer those yields, those starting yields that are just too good to be true. Maybe they're 10%, 20%, 15%, huge yields, too good to be true. What I've often found with these types of companies is the yields are not sustainable. They'll get cut. They're oftentimes a reflection of a company, maybe where the stock price has gone down and the yield hasn't been cut yet, the dividend hasn't been cut. What I like to do in my own portfolio is invest in companies that have a reasonable payout ratio. Payout ratio is basically the amount of dividends going out as compared to net earnings. And I like to invest in the companies that have payout ratios around 50%. Maybe my starting yield is not super great, but I know as a dividend growth investor that doesn't matter. What matters is my yield over time. What's it going to be in 10 years, 20 years, 30 years? Is the dividend sustainable? Is it growing? I can achieve that as long as I invest in those companies that are prudent, they manage their financials well, and I just avoid those yield traps. So especially for newer investors out there, just be really careful of yields that appear just too good to be true. So mistake number 2, lump sum investments. We're in a stock market right now that's doing pretty well. Stocks have gone up. I don't know when it's going to correct. It may be tomorrow, it may be 5 years from now. But what I have learned in my own experience is I try to avoid lump sum investments. I try to dollar cost average in over time. What this means is basically investing incremental amounts each month. This mitigates risk. This makes sure that I can get the best possible purchase price, and it just allows me to sleep at night. And in the world of dividend investing, it's easy to do this with dividend reinvestment plans and with discount brokerages. So just something to keep in mind. Avoid those lump sums, average in over time. Mistake number 3, investing in companies that I don't love. I've bought companies over the years that I don't really love. I'm not passionate about them. As a dividend growth investor, the payout comes 30 years from now. It comes when my cash flow that I'm receiving is greater than my living expenses. I can only be disciplined and stay in it for a long time if I'm buying companies I care about, companies I love, companies I enjoy tracking. Can't buy those companies I don't love, companies that I'm not passionate about. How am I possibly going to hold on to those for 30 years? How am I possibly going to research them, follow the earnings reports over time? It's just not going to be fun, not sustainable. Mistake number 4, waiting. We've all been in these scenarios where like, what if I just wait? What if the price goes down? Well, what if it doesn't? As a dividend growth investor, money is not your most valuable resource. It's actually time. It's the compounding. It's the snowball effect over time. So what I like to do is start now. Mitigate the risk with dollar cost averaging, but start now. Don't wait. At least that's what I do in my own portfolio. Mistake number 5, investing in companies that may not be around for the long haul. This ties into yield trap a little bit as well. Sometimes when you're investing for dividends, you want to look at these companies, they look like they have a good entry yield. Sometimes these are the companies that just aren't going to be around. Best thing as a dividend growth investor is to stick with companies, avoid trading, at least in my personal portfolio, it's my personal opinion, and pick the companies that are going to be around forever. So companies that won't be around, I just try to avoid them. I don't want a company that's only going to be around for 10 years or 20 years. I want a company that's always going to be around, and I always make that one of my prime investment criteria. So this is PPC Ian, ppcian.com. I'm passionate about dividend growth investing. These are just 5 insights, mistakes I've made over the years that I wanted to share with you in your own journey as a dividend growth investor. This video is just for fun and entertainment. Just sharing my passion with everyone. Do want to let you know I'm not a licensed investment advisor, and it's not advice today. This is not investment advice. So please do go out and speak with a licensed representative, licensed professional before making any financial decisions. Thanks for watching. I will see you in the next video.